Hi everyone, my name is Ankita Roy and I manage agricultural options at CME. Following my talk, we have Dave Reif, who's the director for the interest rate options product, followed by Tom Boggs, who directs the equity options at CME. So I'll start with our ag options first. At CME, we have a huge portfolio. It's a diverse portfolio of agricultural options. We have outright options, which are standards and cereals, spread options, which are calendar spread options, inter-commodity spread options, and inter-exchange spread option. Now, recently, you must have heard that we acquired Kansas City Board of Trade. And they have a wheat product which trades a lot in volume. And we have our own CBOT wheat product. So we are looking to launch newer products. And that's a classic example of inter-exchange spread options. We also have short-term options. Now, these are new to our portfolio. Weekly options and short-dated new crop options are some of the examples of short-term options that we have. And weekly options got launched around this time last year. And short-dated new crop options got launched just this year in mid-June. So with that chart, I'll go on to show you some stats here. This shows the realized volatility in corn and soybean, and you'll see that it peaked sometime around June and July and August. Any guesses why? It's the drought, of course. It's a drought in the Midwest, and because of that, implied volatilities hit record levels, 50 to 51% for corn, and the same thing for soybean. And that resulted in very high volume of trading in options. And since we have the short-term options, the weekly and the short-dated new crop options, it was advantageous for people to trade around those at a much cheaper price than the standard options to manage the event-driven risk and the short-term price risk. So just to give you an idea about our products, these numbers are year-to-date over here. So you have corn, which is the most liquid product, followed by soybean options, wheat, meal and oil are the oil seeds. Live cattle and lean hog are our livestock, liquid livestock options. And class 3 milk is our most liquid dairy option. So corn trades around 110,000 ADV for the year 2012. But having said that, if you look at the Globex percentage, it's around 34. And this is a little outdated. This is as of July. Sorry, as of June. So if you have July and August, what happened because of the drought, there was immense amount of trading that went on, and that led to our Globex volumes go up to 45%. If you look at the charts here, you'll see an example of our ADV and open interest and the percentage traded on Globex, which kind of went up during this time. And the same story for soybean options. So these are all outright options or standard options, and it's used by our commercial hedgers and also the trading community to take different kind of advantage of trading opportunities as well as hedging. So long hedgers as well as short hedgers using our outright options to hedge their portfolios. And that has been the traditional paper trading in our asset class. So we have different kinds of options that launched very recently, and let me go through some of them with you. The short-dated new crop option, this was launched in June 4th of this year. What this is, it is a short-dated option. As the name suggests, it references the new crop. So for corn, it references December, but it expires earlier during the growing and the pollination season. So we have two contracts for this year, July and Sep. So you have an exposure to December, which is the new crop risk, but you have an expiration that happens in July and August. So this gives the hedger the facility to hedge earlier in the growing and the planting season at a much cost-effective way, because premiums are much lower because of the lesser time value. It helps to manage risk during specific windows during the growing period. It is also useful to trade around key economic reports, because December, which is the new crop, may be impacted with the different USDA reports that come out. And so it's useful for that. And I'll show you in a bit the Greek sensitivities around the options for the short-dated new crop. And it's interesting how it behaves compared to the standard options. This can be used to do different kind of arbitrage strategies between outrights, CSOs, and short-dated. This chart shows how the two contracts that we had this year behaved. And if you see the first day of trading, it was around 2100 ADV. So that is a record for any option that was launched this year. And it was open for 2 months, but it performed very well. This is the calendar, so we have 3 contracts at every year. For wheat, the cycle is different. For wheat, we launched the product in September, and it references July, which is the new crop. Now, this table shows you why one should use a short-dated new crop option against a standard option. So it gives you specific risk management tool for a certain time, a certain period, and you pay a much lower premium compared to the same kind of hedging, which is basically buying a put option for a producer and paying a much larger premium if you do the same thing with a standard option. So that is the advantage from the commercial perspective. This is an example. The reason I put this example is this is something that happened this year. And because of extreme weather situations or any kind of extreme situation like a drought or flooding or damage of crop, what happens is implied volatilities rise so much that it creates an arbitrage situation. Such a situation happened this year. Of course, we know about that. So the red line here shows you the short-dated CEP implied volatility, and the blue line shows the standard CEP implied volatility. So the red line references these. It was not that impacted. The vols are high, but not as high as the CEP. So we know that there is the vol spread is really high, but eventually these two are going to come back and be something of this sort. So this creates an arbitrage opportunity for speculative traders. The same thing can be reversed if in a situation, in an extreme disaster situation damaging crops, you have your new crop impacted more than your CEP standard. Then the reverse situation happens, and this also creates an arbitrage opportunity. And this is something that was very popular with the prop trading community this year. Just wanted to tell you how the Greeks are different from the standard options. So the Greek for the short-dated options are different in the sense that the theta has a rapid decay compared to the standard option here. The gamma also extremely highly sensitive to any market event that happens, and it's different from the standard option. The vega drops off rapidly and exponentially compared to the standard, and that is the reason why you pay a lower premium. Weekly options. Now, weekly options, I am guessing everybody knows about these. We have weekly options across the board. For CME, we have it on all asset classes. For ags, we launched it around this time, around late summer last year. And these are great to trade and hedge around USDA crop reports and weather reports. The main difference between the weekly option and the short-dated option is the short-dated references the new crop and the weekly's references the nearby. It's always referencing nearby with 4 open contracts every time. So this reduces your hedging cost because it has a lower premium because of lower time value. And this chart shows how the weekly options have performed and grown. This is till July, but till date I know for a fact over 1 million contracts have traded. This is an example. It's pretty self-explanatory. So here you have four weekly options. I'm looking at the pricing window for the last weekly option or weekly option number 4. If because of a USDA crop report being bearish, what happens is the price drops by 40 cents. If you're long a weekly put option, then you gain on that particular strategy. The same thing happens. The reverse happens if the USDA crop reports are bullish and the price hits limit up by over 40 cents, so it's around 60 cents, and you're long a weekly call option and your strategy gains because of that. Calendar spread options. Now, I'm pretty sure most of you have heard about calendar spread options, and calendar spread options have been there for some time. However, we see recently it has gained more traction. So these are very useful for inventory risk hedging and also to take a specific trade on a market opinion. So it allows hedgers and traders to hedge and take views on calendar spreads with one transaction. It's sensitive to the value and the volatility of the underlying spread. So the option is on the spread and it doesn't depend on each leg. So obviously that means it prevents the slippage risk or the leg risk. And these are very popular for commercials, for the hedging community, for the inventory risk hedging, as well as the trading community. So the way it's defined, though, the spread is front month minus the deferred month. So when that spread is positive, the curve is in backwardation or inverse. And when the spread is negative, the curve is in contango and carry. The chart here shows that on a monthly basis, we have around 50,000 to 60,000 trades on calendar spread options. It's mostly done on the pit, so it's not really liquid on Globex, but on pit it's very popular and people trade them every day on a large scale. And I'm not going to go through this matrix, but it's very useful and you will have a copy of this to show you what are the different combinations of buying and selling a call and a put on CSO and what exactly you are doing. Now, it can be confusing for some people, and I remember I gave a seminar in this room a couple of months back just on calendar spread options because the strikes are negative. When your curve is in carry, the strikes are negative because the convention is front month minus deferred. So that can be confusing for some people, but it's really essentially the convention. So if you're not, you're not into these trades yet, and if you want to talk to your customers about it, I think we would really want to increase the volume here and spread the message. So you saw we have outright options, we have our standard options, but on top of that, we have a class and a big portfolio of different other options. So having said that, if you have any questions, feel free to ask now or reach out to me. My contact information is right here. And so if there are no questions, we'll go on to the next speaker, Dave.
Thanks, Ankita. Again, I'm Dave Reif. I manage all the interest rate options at CME. And today I'm going to talk about Treasury options for the most part. I'm going to spend most of the time talking about those, but also talk about some of the Eurodollar options. And I'm not going to get so much into why or how you trade these, but I'm going to show you some of the trends, give you a couple of trade examples that we've seen, and also kind of give you a little just show you some examples of how you could use some of the options and some of the trends to even possibly make some futures trading decisions. But also, if you do want to get into the option game, some possible things that you could be looking for or looking at. So hopefully it'll be of value to you. So just a quick overview. Interest rate options are definitely our largest options products that are traded at CME. Average daily volume between the Eurodollars and the Treasuries is over 800,000 contracts a day trade. About 350,000 of that comes from the Treasury options. Eurodollar options, about 500,000 or 600,000 of that comes. That's a little different than it was even last year, where in the Eurodollar options we were seeing volumes of typically over 1 million contracts a day. It's dropped down a lot, as we all know, with interest rates. You just don't have the volatility in the market. You don't have the curve risk that you would have. So we don't see as much volume coming from the Eurodollar options, but Treasury options have really been active lately, which we're going to get more into very shortly. In terms of trading, they trade in the pit, they trade on Globex. They also trade what we call X-pit, is block trades. Very small percentage trades as blocks, way less than 1% in the Treasury options, and right around 3% in the Eurodollar options. A couple big new additions is, which we're going to talk about, weekly Treasury options, which Ankita talked a bit about, and the grain products. Mid-curve options, which I'll explain to all of you, and some longer-dated Eurodollar options. So let's move on. This is just a visual that, just like as in the futures, options cover the entire curve. We have all the Eurodollar options, which would be considered STIRs or short-dated options. But we also have all the Treasuries, for the 2 years, 5 years, 10 years, bonds, and the ultra bond options. And of course, we have Fed fund options, which, similar to the Eurodollars, they're not trading a ton these days just because of the fact that there's really no short-term interest rate, or hasn't been for a while. Right here is a quick graphic you guys could all read. I won't get into it a whole lot, but of what typical average daily volumes are. Two biggest, Eurodollar options over 500,000 a day. 10-year note options is the big Treasury one that most people are involved in, and there you're seeing about 2,250 a day. And then the bonds are still super popular, especially amongst traders who are kind of dabbling in the option world. I think people just kind of look at bonds as what they think of when they think of the Treasury complex. But as we know, the 10-year is the benchmark. All right, so here's probably the most important story, and the thing that I want everyone to leave with is there's a perception that options don't trade on Globex. They don't trade on the screen. There's not any opportunity unless you're on the floor. But as you see on this graphic, in September, Treasury options reached over 50% of their total volume was done electronically, which was huge. It was actually 54% in the 10-year options. Or I'm sorry, 56% in the 10-year options and 54% electronic for the Treasury options as a whole, for the whole complex. Pretty significant. First time we've ever reached over 50%. Q3, we were just under 50%. So it's definitely, as you can see, a trend where we've been around there. If you jump back to March 08, which is way towards the left in the chart, you see we're right around the 30% mark. So in a few years, we've jumped up now that we're trading over half the volume. So what have we seen now? We've seen a lot more opportunity for people to be involved trading Treasury options. We've seen some traditional futures geared firms getting into Treasury options, more algorithmic trading, getting involved in employing algorithms that they use for futures into the options world without feeling that, hey, I'm at a really big disadvantage because everything's going on in the pit. So that's the key story on my slide 22 here that I want everyone to leave with. And here's an example of that. This is just a quick snapshot from our EOS Trader, which is the free option system that CME gives away. Allows you to trade all outright options, but also strategies. And I hope it's not too small. What I really want to show you here is, most people in options like trading strategies. A lot less risk, and then usually a lot less premium to trade strategies, especially the common ones. Just like futures, there's spreads, there's calendar spreads, there's call spreads, which are verticals, butterflies, condors, similar techniques, very little risk if you're buyers of these types of strategies. All of this trades electronically. In the Treasury world, you see things, you see straddles, you see verticals, you see trees, all different kinds of option strategies. All this is now traded on Globex, which is really what helped us raise our electronic percentage, as that's the big volume trades typically. So just recently, as Jan of 2011, we introduced weekly Treasury options. which we saw the success of weekly Treasury options, which Tom Boggs is going to speak to, in the equity options, and thought that it made sense in the Treasury options. And in just a second, I'm going to get into why people really embrace these. But to throw some numbers at you, they were launched in Jan 2011. As of yesterday, 6.75 million options have traded in these, which is pretty successful option as a new product. It's really an options extension, a new expiration in the Treasury options. However, to be trading over 6.75 million in a little over about 17 months or so is pretty significant. Of that 6.75 million, about 5 million of them, or 4.5 million rather, have traded this year. So we've more than doubled the volume we did last year. People have really embraced these. Why have they? We found that people like the short-dated option, lower premiums to trade, which I'm going to get into an example, and it's a great opportunity to trade really big economic events or to hedge risk that you might have in the futures world with options on something, an unemployment number, a Fed meeting. There are a couple examples of that. So let me kind of show you here. These are our largest trading days. I think the top 12 largest trading days. If you look at the top row, on September 7th of this year, we traded over 100,000 weekly Treasury options. And that's in addition to the normal Treasury volume, which is probably another 300,000 contracts or so. That was the day, that was September 2012 unemployment number that came out on that. And if you just read down the list, I won't read it all to you, you don't need that. You read down the list and you'll see our largest days have been around big economic numbers, economic events. You see the Fed Jackson Hole meeting that they had a month or two ago. That was one of our biggest days. European news, that's where people are really taking advantage of these or using these to hedge their risk. So I'll try to get an example across to you on why people use these weekly Treasury options and why they're important and why they've really increased the volume in the Treasury complex as a whole. So if you look at the second row where you see the 10-11 market, that was the weekly option that was expiring on the day of the Jackson Hole Fed meeting. That was in August 31st or so. And if you see that the 10-11 is the premium that you would pay for the option. So in this case, and just to take it simply, to pay 10 ticks on a Treasury option would be about $150 to buy that option, to buy a one lot. Back before we introduced weekly Treasury options, your only choice to hedge something happening at that number would have been what's on the bottom row where you see the 37-38 market. So almost 4 times as much premium. We'll just, for simple math, we'll say it's 40 ticks. So almost 4 times as much premium to buy that option. That's an expensive hedge. That's an expensive shot on an economic event to have to pay, $600 per one lot as opposed to $150 per one lot. So people have really come into the weeklies to trade them right around economic events, right around unemployment numbers, and like I've gone through with you. And what we've seen is most people, based on this chart, the far 2 bars, the high ones, are the punchline. Pretty much all of our weekly Treasury options trade with 1 day or 0 days left to expiration. The Monday, the Tuesday, Wednesday, you don't see them trading a whole lot. But once you get to the Thursday and Friday, right around the expiration is when people are coming around. So it's showing people are interested in these around these economic events. They like to trade them right around expiration. The future's floating right around a certain price. They buy these options to hedge either a move through that price or just to say, hey, I'm going to take a cheap shot on this. We might get a rally. I'm going to buy these options here. And it's a much cheaper way of doing it nowadays than it was, back pre-Jan 2011, where you would have had to spend a lot of premium to buy an option that didn't expire for 3 or 4 weeks and, just kind of sit on it. People wouldn't take these shots. People wouldn't hedge their risk. Typically, they'd go into an OTC world to do that, which now they could do it in the futures world. Ankita.
On your previous slide, the economic reports can happen at any time of these 30 days or 21 days when the option is open. But this chart shows that it peaks around expiration only. Mm-hmm. How do you account for those days when a government report comes out?
Well, we list weekly options 3 at a time. So you could trade a weekly option that expires in 3 weeks, in 2 weeks, or 1 week. People wait to trade them until the week of. So basically, they'll sit out there, and there's some things going on. But when there's an economic report, they're really just trading that weekly that expires on that Friday. They're not like, no one's saying, hey, I'm going to buy a weekly option for what would be November unemployment number. They're not buying it now. They're waiting till 2 days before that unemployment number, or 1 day before that unemployment number to buy it. So, any other questions before I move on? All right, so quickly we'll jump into the Eurodollar options. I won't spend a ton of time. Frankly, Treasury options for people more newer, looking into the options world. Treasury options is probably a better get into, but I know there's quite a few Eurodollar traders. And so we've had, as I mentioned, the curve has been extremely flat. Volumes are down pretty significantly. And where people are really looking to hedge risk is further out on the curve. 2015, 2016 Eurodollar futures. We don't have options that go out that far, that expire that long. And not to mention, you take a 2015 future, let's say a March 2015 Eurodollar future, when you think about it, that would be an option that expires in probably close to 600 days. You don't see people liking to trade options that have really a whole lot of time value in them. A lot more risk and a lot more premium, as we talked about. So what we've had at CME since 2003, really, and even some of them a little bit before that, are what we call mid-curve options. And what those are they're short-dated options on a long-dated future. So you take a Eurodollar future that expires in, let's say, March of 2015, you could trade an option on that future that expires in December of this year, or March of 2013 also. So basically what they are they're a short-dated option on a longer-dated future. All options expire into a futures contract. However, the future they expire into is a deferred. So you'll take on the futures position when the option expires, and you actually have that future for a long time, or you could take possession of that future without it just expiring at the same time. So I hope that made sense. So here's a little bit better example is we have 1-year mid-curves, 2-year mid-curves, 3-year mid-curves, and 4-year mid-curves. All of these options expire, for instance, in December 2012. But as you see, the red 1-year mid-curve, the underlying future is a 2013 future. The green is a 2014, the blue is a 2015, and the gold is a 2016 future. So they're all very short-dated options, expire in December, so 2 months away. However, the underlying future, so there's movement on those futures. As we all know, that's kind of where the Eurodollar futures have moved now and where the curve risk is, or the perceived curve risk. So what we've seen is a huge pickup. We've had the green Eurodollar or mid-curve options since, I believe, 2003, and they never traded more than 1,000 contracts a day. And back in 2010, when people started to think that that might be where there's some movement, so that would have been like a 2012 area at the time, future, we saw volumes really pick up. And similarly, the blue mid-curves, which were just launched in 2011, those trade 200,000 contracts a day now. Definitely our largest Eurodollar option that trades. And an example, this last bullet was back in January, we traded over 700,000 contracts when the Philly Fed president, Plazer, talked about he felt the economy was a little bit better than some of his colleagues were making it seem with the rates. Had huge days in the blues. So let me talk to that a little bit. Here's just a quick graphic of how our blue mid-curve volume has grown. As you see, it's pretty much flatline when we launched these. We didn't trade them at all. And then back in August of 2011, if anyone here remembers, that's where the Fed came out and they said that they didn't expect to have any rate increases until probably the end of 2014. So that was the first time they spoke. And that was in August 2011, and look what the blue mid-curve volume did on that day. So when I talk about tracking some of these as a way to possibly get an indication of Fed policy or possibly where rates are going, I think looking at options volume, looking at options open interest is a great thing to do because of the fact is this displays Fed policy to a T, and we've seen option moves and big option days. We've been down for the past couple of days. We had some huge put days go on in both Treasury and Eurodollar options about a week ago. So to take a look at that, and not saying that's going to help your futures trading or help your options trading, but it seems that the market with options seems, you can see where the money and the bets are really going in terms of what they think the market's going to do. So in August, I said that's when the Fed talked about 2014. And then things started improving a little bit. You see the blue volume go down around DECE 11, even going into NOVE. And then Jan is when they came out and said that now they're thinking it could be even 2015. And that's right around the time that Placer spoke also and said, you know, hey, it's not as bad as they're talking about. So we saw the volumes really pick up. So now you get to July and August, and you see the volumes go down again. So why did that happen? Well, if you look at the far right of this chart, those are the gold mid curves. That's like a DECE option on a DECE 2016 future. Those things have been around since 2003. They traded about 1,000 contracts a month, not a day, a month. And all of a sudden, back when we had a couple crummy unemployment reports in June and July, all of a sudden everybody moved into the gold because that's where the perceived curve risk was. So you saw people start moving into the gold mid curves. Blue volume started coming down a little bit. But this is what's really interesting is if you look at this whole chart, you see the greens, and again, they weren't trading at all, and right around mid-July, you see the volume pop up in those. And I don't remember what it was, but there was a lot of economic talk going on then, and that's where the perceived risk was. And you've seen as things have changed, as the Fed has done more, QE2, now talking QE3, you've seen the risk move out the curve. And you look at the blues, you look at the gold, and they've, I run the options, they call these kind of my summer blockbusters all of a sudden. Is right around July, it seems like we have a new option that really picks up its volume. The unfortunate thing is, as in the futures, that the deferred options volume isn't anywhere near what it is if people are trading in the front month. And we've seen the same thing in the Eurodollar futures, where, yeah, it's great, there's some back month volume, everything's great, but it's not as good as the whites and the reds, the front month's trading. But it's still nice to see that we still have the products and the volume is still there for people. All right, and finally, I'll be real quick on this. I talked about nobody wants to trade a really, really long-dated option. Kind of lied to you. There are people who want to trade long-dated options. Back last October, so just about a year ago, we expanded our quarterly options. So we list options that go out three years of quarters. So basically, you could almost trade an option now that's close to 900 days to expiration or so. So about 3 years to expiration. And high vega options. There are people who have embraced them pretty decently. Our open interest, and this is actually, it's a little bit stale, our open interest now is just about 400,000. So people are trading these deferred options. Swap desks like these a lot. It's a expensive option, but it's a good way to really hedge some of the curve risk and to take on, really long-term hedges. So that was done in October. And this is just a quick chart on how that volume has grown. I won't bore you with that. And finally, I talked about a little bit on using options to get market sentiment and to possibly judge what's going on and where the market thinks things are going. We do have an open interest tool, and this is actually for all products. It goes across ags, equities, FX. If you go to this link here, you'll see the link to all the other options open interest tools. It's a graphic display of what open interest is, where all that open interest is accumulated, and how it's changed from the previous day. So it's a quick way to see graphically on the call part of the skew and the put part of the skew where the big open interest holders are. So I just want to point out this tool to all you folks because it's a nice reference. And the last page here are some other resources that we have available for everybody in the options world. And with that, I believe I'll turn it over to Tom Boggs to talk equities with y'all.
Thanks, Dave.
Sure.
My name is Tom Boggs. I'm a little hoarse today, so I'm going to skip the podium. But I manage index options at CME. And hopefully you all trade them, and your customers trade them, and your family members trade them. We're doing about 215,000 contracts a day in S&P options at the CME. We're not known as an options exchange. And what we're trying to do collectively is try to change that perception in the world by going out at meetings like this and clarifying for everybody what our products offerings are and how the products work. So we've got two different products in S&P 500 at the CME. Basically, we're a one-trick pony when it comes to index options. We do have NASDAQ and Dow and mid-cap, but about 95% of our volume is S&P 500 contracts. And basically, everybody's familiar with what the S&P 500 index is. So it's not as dramatic or as complex as some of the other product suites, but it's pretty straightforward, which seems to attract a lot of interest. We have two product offerings. We have the large product, which trades on the trading floor with a $250 multiplier, which is basically an institutional sized product. If the index level is 1,000, the value of that's obviously 250,000. And the E-mini, that's 1/5 of that size, $50,000 contract with a $50 multiplier. So basically, we have some cross-margining offsets is a key benefit. Operational efficiencies. One-stop shopping is a big theme for us. Futures and options on the same platform. Both trade electronically as well as on the trading floor. And then 24-hour access with Globex. And what we're going through here is basically our pitch book that we use to talk through the product suite with new users, asset managers, state pension funds, hedge funds. It's pretty straightforward, but we did some research and we found out that everybody's familiar with spider options and another cash index product that trades in the neighborhood here that we don't like to mention, but they get a lot of attention. So what we've done in our pitch book is try to clarify the differences and the similarities between the two. So we have the S&P 500 index, two products that I mentioned. The NASDAQ 100, again, two size products, a $20 and $100 multiplier. The Dow Jones products with a $5 contract on Globex and a $10 contract that is listed on the trading floor but really doesn't trade. And then the S&P Mid-Cap 400, which trades electronically on Globex, but a very tiny amount of activity. And this is hard to read from back here, but I do have a handout for everybody to take if they haven't seen it. So what we've done is take a very simple product and made it very complicated. So we have two different versions, the multipliers that I mentioned, and then we have two different styles. S&P products traditionally have been American style options on the CME, which means you can exercise at any time, obviously. But we introduced our weekly and end-of-month options that Dave and Ankita mentioned as a European-style product. And in doing so, we went from, when we added the weeklies and the month ends, we went from a couple years ago, we had 12 expirations in these products. This year we have 59 expirations, which is attractive, obviously, for our side of the fence, but also for most end users. We found, especially with the short-term options, there's better usage of our product on a short-term basis, possibly than on a long-term basis. It's as if you could buy car insurance for the moments you're actually using your car, as opposed to the paying a premium for it when it's sitting in the garage and you're not using it. So you might pay a little higher premium for the shorter duration, but overall it's less of an expenditure at that moment. So we have American-style options for the S&P 500 and the E-minis, as well as European-style weeklies and end-of-month options that trade on the trading floor. Is that clear, or have I overcomplicated it? In addition to the European style for the weeklies and the month-end options, they settle on a different basis. We have futures only trade quarterly in the S&P 500. So March, June, Sep, Dec. So those quarterly options settle into with the quarterly future. So the Decembers will settle into Dec futures, which then settle to cash. So 4 of the 59 expirations settle into cash. The other 8 monthlies are serials, like this Friday is the October serial. That will settle at 315 into the December futures contract, because we don't have an October futures contract. And the month ends and the weeklies also settle into the next open futures contract. So what we've done with these is we maybe made a better product with the weeklies and the month ends. They now comprise about 20 to 25% of our volume on a daily basis. Last Friday, expiration Friday for the weekly, they made up about 34% of our volume. And what we've done is change the settlement mechanism. We do a volume weighted average at 3 o'clock, a VWAP of the last 30 seconds of trading the E-mini futures contract, and we fix a price at 3 o'clock. The symbol is ESF. So we print that E-mini futures price at that moment and settle the options to that ESF price, which means, especially for the serial options, you don't have pin risk. People familiar with pin risk? I know Charles is very familiar with them. So what we've done is pin risk is added uncertainty about whether or not your option will be exercised. Option holders obviously are in control of that mechanism, but option sellers go through the weekend not knowing on a serial option if they're going to be assigned or not. So you have risk, which reduces a lot of your investment in that product. You want to manage that risk, so you might avoid them. But with short-term options, the pin risk is determined at 3 o'clock. And then you know if you're going to be in the money, and you have 15 minutes to hedge that with a futures contract. We also have with the short-term options, what I tried to call a better gamma, but our marketing people would not let me use the word better gamma. Dave mentioned higher gamma. So you have more rapidly responsive gamma, which attract a lot of people interested in trading gamma as well as hedging their gamma. So we have a lot of additional data here in our pitch book of why customers prefer our options to the cash options. Basically, both one-stop shopping, futures and options on the same platform, 24-hour trading. We trade more S&P options electronically than the cash options exchange does. Obviously, Spider options trade massively electronically, so we won't talk about those. So basically, the option strategies that you're familiar with across all option contracts are available and applicable to E-mini contracts. But as we meet with end users, we found there's directional trading, portfolio hedging, collar protection, obviously, tail risk management. We've recently discovered a few state pension funds that are using S&P floor options with collar protection to do some automated portfolio rebalancing strategies. When the equities go up 10%, they're going to be a seller to rebalance their portfolio, so they will have sold calls up 10%. If they have to do the same on the downside, they'll be a seller of puts. So what they're doing now is selling strangles to put themselves in the position, if they have to adjust, they have a position fully hedged and approved. And if they don't have to adjust, they've collected premium. So that's been a big institutional usage recently. We've had a pickup and an adoption of that strategy. Tail risk management, everybody has to manage the tail risk. So we've had a lot of short-term option usage, hedging that tail risk. They have long-term hedges in place, but they'll be hedging that tail risk on a short-term basis around the news announcements that Dave mentioned in detail. And those strategies are all applicable to the Globex options. We find an increased amount of spreaders now joining Globex. Trading floor on the S&P pit, we have about 95% of that volume takes place as a spread on a given month. On Globex, it took us a few years. We sort of expanded this program in 2004. It took us about 6 or 7 years to get spreads adopted on Globex. Now we have about 15% of our E-mini volume on Globex trade as spreads. So that's 1.5. It could be great if I got up to 50, but we'll get there. And then, as I mentioned, for the weekly and end-of-month options, short duration trading, cheaper premiums, doing buy rights with weeklies, gamma trading, and trading the news. And obviously, the types of customers vary by strategy, but we do find that more and more, all customers are now looking at all strategies as we enhance our option portfolio and come up with some better products such as the weeklies. So that's an exciting change for us. As I mentioned, we have a lot of flexibility. Options give everybody flexibility. It's a great flexible tool. And we went from 12 expirations a couple years ago out to 59. And this is on our website and in the handout I'll give you. But basically, on every month, as you can see now, I guess this is February, hopefully it's next February, we have the 3 weekly options in the light blue, the standard third Friday option, and then an end-of-month option. And what makes this really pretty interesting is you could have an end-of-month option here on February 29th. Is it a leap year next year? I hope so.
No, it was this year.
This year, so that's this year. So on February 29th, we had a month-end expiration on a Wednesday. 2 years later, we had the March week 1. So that makes for a lot of spreading, midweek spreading. And people have asked us if we thought about creating daily options. And basically, we think we have enough with 59 expirations. And you can, to Dave's point, a lot of these people trade 1 or 2 days ahead of time anyway with our weeklies or our month ends. So we have pretty good coverage on the expiration cycle, which from my perspective just simply explodes the spreading opportunities geometrically, which makes for better opportunities for everybody. So we also have real-time quotes available on our website, which is a good pitch book point because it introduces new users. They can quickly go on our website and look at the quality of our markets. And because we're the only really tight electronic S&P option of any notional size, a lot of people go to this page to price floor trades or OTC trades or trades on other exchanges. Ironically, a lot of the institutional meetings I've had this year, people say, oh, we look at your prices, and then we try to do a trade elsewhere. So we're honored that we have high quality prices, but we're trying to get those people to trade our product also. So we have real-time bid-ask as well as size running all day. And one more point on the weeklies, we currently list 3 weeklies at once. By the end of November, we'll be listing 4 concurrent weeklies, which a lot of people, especially on the asset manager side, have come to us and asked for those increased weeklies because they roll their hedges as frequently as they can, or it gives them a lot of flexibility as to when they're going to roll. So we have a resource page for options, which gives you some more information about the product as well as some white papers. I think David also mentioned the open interest tool, which is available for all of our products. We have some contact information, and then we also have an options update website, which aggregates information from all of our asset classes. Up until this year, we've sort of marketed and promoted each of these separately as an asset class. And Dave's in charge of an initiative to promote everything cross options products at the CME. So people like you get the insight at one meeting instead of 6. So any questions about index options or any of our other option products? Charles.
Well, obviously I'm pretty familiar with index options. On the agricultural options and the interest rate options, particularly the weeklies, the shorter dated options and so on, are those American style options or European style options?
For ag options, it's American style options, and they are physically settled. So when it expires, you hold the future.
Okay, and it goes through the same kind of pin risk. I can abandon an in-the-money option, it can be exercised on an out-of-the-money option, and I might not find out for days.
Similar in Treasury. They're all American expiration, and you do have the same pin risk issues that you could have in the Treasury options. I actually looked at possibly changing them, and I've also had feedback to people who wanted me to change the standard options.
I'm sure you have people that don't want you to change it too. So
it comes out more tilted towards the traditional users, like the optionality of having that, the contrary instructions. So we've thought about changing the weeklies, but you get in this world of it's working pretty good, but could we grow volume? So something we're always interested in hearing feedback in. Always open to looking at, but for now they're all American with contrary instructions.
So for viewers later, the question was, do ag and interest rate options settle, the newer ones in the weeklies and the short-term options settle as American or European? And the answer is American. Do you have a question?
I was actually going to ask, why don't you, if you decided with the equity options to make them European for the 50-some expiration, why don't you do that with the cereals as well?
We looked at that, and we may do that in the future. I brought it to the trading floor community last year and the market maker community. We have 30 market maker firms stream quotes into Globex. And I initially presented it as a side-by-side scenario, which is a little bit too complicated. From the customer perspective, we want to make sure each customer knows, at least on that date, what they're going to get. So that's something we might take a look at in the future. A lot of people who trade options actually like the optionality and the uncertainty of options, right? There's two sides.
You mean the market makers that want the edge, right?
So yes, a lot of customers actually don't mind getting paid for the optionality of an option. So there's two sides to that, but it's a good question. Anybody else? So we'll be here if you have any questions.
Okay, thanks Tom, and thanks Dave and Ankita. I want to thank everyone for coming. A quick announcement, 2 weeks is FIA Expo, which is a Futures Industry Expo. Advantage Futures will be exhibiting there. CME has a huge party on October 30th. So if you haven't registered already, it's free to register. If you're on the Advantage distribution list, you should be getting an email this week allowing you to register. And I encourage you to attend the expo, and hopefully we'll see you there. Thanks again.
Thank you.